Hey, welcome here. My name is Daniel Fehr-Krahn, and I'm out of Winnipeg. And today we are going to have a discussion about long-term goals and really about how to structure when you are saving, how to structure that savings and some of the different options we have when it comes to how to put that savings in place. Sorry about that. I had a YouTube timer that just went off for 1 minute to start on time. And but we're going to go through some maybe some technical details and try to keep it simple and try to make it so everyone can understand their finances. But as an introduction to me, I've been in this campaign about over 10 years now, and I got started in my early 20s, really just looking for an alternative. I worked as an employment. I worked in construction, where I found out I could only make money by giving more time and maybe get some more skills. But I wanted to have a new industry. I didn't want to work in construction my whole career. So I got started here, and it's been a real blessing to me. And now, fast forward, I got a wife and two kids, and life is good. I'm very happy. But let me share my screen and let's jump right into it. You didn't come here to hear my life story, I don't think. But today we're talking about long-term goals. Here we are, long-term goals and moving. I'm not sure if when people join, you guys hear a big ding, but if you do, that's fine. If you don't, that's fine too. I'm just setting up my screen so I can see you guys and I can see who's in and out and also see the chat room. But let's jump right in. Long-term goals. When it comes to long-term goals as an intro, many times we have a long-term goal of maybe one day retiring or one day paying off our house or one day our kids go to school, but we don't always have a goal of like an actual strategy how to get there. And so we're going to go through that today. We're going to go through in such a way that you feel comfortable either applying this to yourself, but our goal isn't just to help you feel comfortable applying it to yourself. Our goal is to help you feel comfortable sharing with other people. Where if you could share with other people, that puts you in a better position to talk to more people quicker. But that's really what our campaign is about, being a part of a campaign where you don't need to be have a big academic background in finance to be able to work in finance. You just have to learn something. If you learn a little bit, then you can share a little bit. But one of the things that makes our workshops unique is that every day we're flooded with information. There's many people that offer financial advice. All you got to do is ask someone, hey, I need financial advice. And most things we do is actually quite common sense. But then we look at, hey, how do things actually work? And we don't have a narrow focus on one or two areas, but we want to focus on all aspects of someone's finance. So we call it a holistic approach. Now, buyer beware, everybody says they have a holistic approach. The bank says they're holistic. The other insurance companies say they're holistic. Other investment companies say they're holistic. Even other platforms that look like ours say they're holistic. And so everybody says they're holistic, but you got to make up your own mind. And we want you to become a specialist in the areas that you want to be, but you got to be a generalist in every area a little bit. So one of our main concepts that we talk about, we call the financial foundation. Like building a house, you build it from the ground up. And so the financial foundation is really where you can look at your own finances and say, what does my finances look like as a picture? And so when we look at it like a picture, we say, if something went wrong, what kind of protection do you have? The main ones are life insurance, health insurance, critical illness, disability, maybe a car insurance, house insurance. If your house burns down, we call it general insurance. And we want to know, hey, what is in place? Some of them you have to buy, some of them you don't have to buy. And so many times we don't buy things like life insurance because you don't have to, but you buy fire insurance on your house because, of course, the bank wants to protect their asset. So one of the things is the two numbers you want to know for your own financial plan: how much protection do you have and how much do you pay for it? The second question is, how much debt do you have? And of course, how much do you pay for it? And we want to get people in a position where they have less debt. And one second. Where they have less debt. Zero debt is best. But in your financial plan, you want to know how much debt do you have, how much do you pay for it? And how much you pay should go into maybe two different categories. One is how much do you pay and is your payment? How much of that payment goes to principal? How much is interest? Is it just going into garbage? How much, how much do you owe and how much do you pay for it? The second question or third question maybe is how much emergency fund do you have? When I look at emergency funds, I think of them like this. If you have a river, I wonder if I can draw on my screen. Got it. If you have a river that goes into your house, you guys see the river. And then you have a lake, and then a river that leaves. And so the emergency fund is all the extra money you have in between while you're operating. Where if my income is $5,000 a month and my expenses is $5,000 a month, it works out perfect, except that income and expenses don't come at the same time. They come randomly all over. So I need to have money coming in and money going out, but I need to have a pool of money to operate from. That's what I believe. But we want to look at emergency funds, make sure you have emergency funds in place. And then lastly, investments, where you're putting this stuff at risk. And so how much have people invested? Sometimes you can use pieces of these. For example, you can invest inside your insurance. You can borrow money to invest. You can just use cash as investment too. So you can also use your debt as insurance. You can use your emergency fund as insurance too. Or you can change them up and think about what is it actually. So when you have a dollar, what category does it fall under? Sometimes it can be multiple categories. Some insurance looks like an investment, and some emergency funds maybe look like debt management or like a line of credit. But we're going to talk about this today. We're going to move on to the investment side. So there's different ways to structure insurance. There's different ways to structure debt. There's different places to store an emergency fund. In investments, you have basically a few different categories. You have your rate of return, your risk, your taxes, and then of course the registration. Do you have any limits on it? Any government grants? Any extra stuff? Let's jump in and start looking at this stuff. We're going to talk about two main things today, maybe three. One is cost of higher education and retirement options. Then we're going to talk about tax impact. If someone says, hey, why am I going to save? Sometimes you just save for self-confidence. Save for, some people save for tax savings. But we're going to look at education first. Then after we look at education, we're going to look at retirement. I think retirement is actually more important than saving for your kids' education, for the simple fact that I can finance my kids' education, but I cannot finance my retirement. That's the main difference. But let's jump through here. Common questions. Do I have to assume all the responsibility for my kids' school? Or when they turn 18, do I kick them out and they're on their own? How much do I want to contribute? What if I do $50 a month? Is that a good place to start? Or how much should I save? Where do we save? What's available? How does it fit into the overall strategy? And so when you look at the cost of education, there's a study that says you might need $233,000 to cover kids' school. Well, let's look at this. What about if you're, sending your kids to school on top of that? So it's really about from 0 to 18, an extra maybe looks like, $1,000, $2,000 a month. If you live in a home, if you live in your parents' home, it's about $4,800. After inflation, about $65,000. $48,000, $65,000. So the true point of this slide is it costs a lot of money to go to school. Now, if I want to be an engineer, be a doctor, be some kind of professional where I get an academic education, I think school might make a lot of sense in 2040 or 2030 when my kids are older. But if someone wants to just get a normal job position, I don't know if school makes as much sense. I don't know if a Bachelor of Arts is worth as much as people pay for it. So we got to be careful as parents to figure out, am I going to send my school kid to get a Bachelor of Arts and pay and save for that? Or what am I saving for? So if I'm looking at just the pure cost of insurance and evaluating with inflation, the first year it's about $50,000. but after inflation, it's about 67,000. So, about 10 grand a year now. In 18 years, 20 years, it might be 15 grand a year. But when we look at in debt from day one, I don't think people should be borrowing money to go to school. I think if you're academically inclined, you can get grants and scholarships to go to school. Universities want the brightest school students. Governments have a lot of programs, but I see people go into debt for a better life, but then they end up with 50 grand and an extra maybe $1 or $2 an hour. So I don't know if it always makes sense. Everybody's unique, and as an adult, you got to make a decision for you and for your kids as well. But when you look at you shouldn't touch your retirement savings, but there's really three places where you can find the money: personal savings, grants, and loans. I prefer personal savings and grants. People are much more careful with personal savings than they are with loans. I don't see a lot of people take 40 grand out of their bank to go buy a car. I just don't see it. But I do see people ought to take 40 grand in loans to go buy a car. So if you save the money, you actually treat that money a lot more seriously. And so if we look at some of these options, if you're saving $100 a month, and school might cost 65 grand. So depending where you put it, if you're saving at a 2% rate, then you probably got to save about $253 for 18 years, and you'll have 65 grand. And if I look at, if you save at a better rate of return, your payment you put in doesn't have to be as much. Now, when we look at the rate of return, this is from a previous workshop. Usually you have your rate of return on one side and your risk on the other, and you have like an efficient frontier where if you want to get 8% return, you might have to be at a risk level that's more than you're comfortable. So we don't want to be investing where we are taking more risk than you're comfortable with. But this is in our textbook on workshop 5. I'm a little ahead of myself. On the bottom of page 45, you can fill this out. So I see people saving in RESPs where they're saving at like 2% when they could be getting a better rate of return. So then if you're saving at 2% and you get a grant, you might be better off saving at 8% potentially and not putting as much in. So let's look at the RESP. Let's look at the rules, then I'll sum up a case why you should buy an RESP if you have kids. One is the government's going to give you 20%, so not 20 grand, 20% on what you put in. So if you put in up to 2,500 and you go back 1 year, but if you put in $100, the government puts in 20. So it's a 20% return right away, one time. It's not every year. And there might be additional grants. But here, if you don't take it out for approved educational institution, the grants are reversed. But you keep the interest on the grants. So what happens is, let's say I put in $100. The government puts in $20. So now I'm at $120. It doubles to $240 over time. And if I don't go to school for government grants, I got to give that $20 back. But I get to keep $220. So I still get the doubling. So the RESP, you get free money if you're saving money anyways. So I think it's a great program that way. Here's some of the rules if you're in your textbook. Earnings and withdrawals are not taxed on the original capital, but the growth is taxed in the child's name. You, the donor, stay in control. So one of the things you don't want to do is say, I want to put money in my son's name because he might be able to go spend it. Contributions are not tax deductible, but if I pull money out, it's allowed. There's no restriction on it, but it's going to count as income tax if there's any growth. So let me summarize why you should be putting money in here. There's 4 types of money that go into an RESP. 4, maybe 5. One is called a Canada Learning Bond. The Canada Learning Bond, you get $500 one time and $100 per year for 15 years. So if you look at a Canada Learning Bond, if you open the RESP, if your income's under a certain threshold, you get that money for free. So it's actually quite easy to sit down with someone and say, hey, Alan, you got kids? Why don't we get this free money? $500 every year. And then the client's happy because they get free money from the government, Canada Learning Bond inside the RESP. And I'm happy because I can go review my client every year. They have an account that's always growing. The other deposit we have in here is, it says deposit. You can deposit money in. You can go back 1 year, so you can put up to $5,000 in. You get $2,500 from this year, $2,500 from the previous year. But let's say I deposit in $100. I'm going to get a grant of $20 or 20%. So if I put in money, I get 20% more money than I put in right away. And then, of course, I get interest on my money. I get to choose how it's invested. And you can sit down with a professional, get that. But I think if you're not going to deposit, check this out. Oh, I can't change color. You get this one anyways. You get the Canada Learning Bond anyways. Now that's earmarked per kid. But I think people should go get that bond anyways. Why not? You know, it's free. It's just a little bit of paperwork. It's not free for me, but it's, you know, it's free for the client. So when you look at grants and loans outside the RESP, a grant means you don't have to repay a grant, and a loan means you have to repay it with interest after finishing school. So the RESP is free money. It's like a grant. You don't have to repay it. And different provinces have different options. But you can go to canada.ca. You're looking at a student aid estimator, and you can look at different factors. But when it comes to finding someone with kids, you can say, hey, let's sit down and look at their options for an RESP. Let me go back 1 second. I wonder if I can get a blank page here. No blank page. Let me go back here. So there's two main programs. One is a pay-as-you-go RESP. Another is what's called a diploma. That's supposed to say diploma and pay-as-you-go. A pay-as-you-go, if you have the account, you can put in money anytime. And usually you pay a fee of 1% of your asset, as in a mutual fund or a segregated fund. So if I put in $100, I have an expense on that of 1%. The diploma program, you have the RESP, and then you have a commitment. That says commitment. You have to put in $100 a month for 10 years or 20 years or whatever it is. And the diploma program, once you start, you must stay in. If you have a diploma program, it's usually best to keep the diploma program instead of switching to a pay-as-you-go. Because what happens is once you commit to that, the agent sometimes gets a little bit extra compensation, and they're very specialized in RESPs. But a pay-as-you-go, it's typically a small account, and it supplements a total financial plan of someone might do the life insurance, the estate plan, the RRSP, the TFSA, and the RESP, and it's a part of the whole plan. Now the RESP, pay-as-you-go, you can get in and out anytime without a fee. So it's very flexible for the consumer, but many times the people that sell the pay-as-you-go plan, one disadvantage is they're not as well trained because they're not full-time RESP people. Because I know RESP, but a guy that does everyday RESP might be a little better. But I know enough that I think a flexible plan, I think is better for me. I'm in a pay-as-you-go type of plan. Start and stop. If I want to stop my payment, I can stop anytime, start anytime. Doesn't make a difference. But let's move on away from RESP. If there's any question about RESP, now is the best time to ask the RESP question. You can chat it in or unmute. And listen, you either save or you don't. That's the issue with an RESP. You know, and you can look, if you're saving for kids' school, it's a great way to go. But you look at emergency fund is paid, debts are paid, universities paid, kids are independent. Now we can look at the retirement program. You know, you don't want to wait, you know, for everything to happen before planning retirement, but you want to be able to plan right away and start saving. Get a nest egg. When it looks like retirement planning, there's three main places: government, personal, and pension. The government has three main programs. One extra program called an allowance, but let's look at these. Old age security. The things you need to know is it's about $650 a month for OAS, and employment history is not a factor. That means if my wife is a stay-at-home wife, she'll still likely get OAS. And I'm on page 46 in the book. If you make a lot of money, you get your OAS clawed back. So it's only for people, I think that's around 70,000. I could be wrong. Your clawback starts, and maybe at 120, it goes a little higher. But CPP is a pension plan built by a sovereign fund, which is a sovereign wealth fund built by the people, where we put money in, and it's I think about $500 billion in the fund already. The way it works is we contribute in. It's not a government program. The government just runs the program, but it's not government money. It's our money. And the average amount someone's going to get is about $800 a month. You could get $1,200 if you have a better income your whole life. But if you have the average person gets about $700-800. You'll get 60% as a pension for a survivor, up to maximum. So let's say I get 700, my wife gets 700, or we use these numbers, and I pass away, my wife would get 60% of mine, up to the maximum. So if I'm already getting $1,253 and my wife passes away, I don't get her CPP. So clients that make 80 grand a year or up are usually around the maximum. And so then if I'm at the maximum, my wife's at the maximum, what happens when we're doing estate planning is if I die, we're living on $2,500 a month. If I die at old age, now we're living on $1,200 a month, because my CPP, if my wife's already getting the maximum, she doesn't get 60% of mine. It only goes up to the maximum. And so many times we want to supplement that with a permanent insurance to say, hey, maybe I want to insure $1,200 a month. Maybe my wife outlives me by 5 years. So I'm looking at maybe a $50,000 policy to insure my CPP. What she loses, I can make up. And then you get some choices with CPP. So you can either start early and get 36% less, or you can take it at 65, or you can take it later and get 42% more. It looks like this. Let's say I got $600 or $1,000 or $1,400. This is at age 65, 60, 65, or 70. What's better, 60, 65, 70, based on your monthly income? Well, if you can live on 600, take it. But some people can't live on 600 a month, so they got to wait till 70 to get 1,400. But if you die, you can't go back. So a lot of times it depends on how long you're going to live and your tax bracket. All of these numbers are taxable. So if I get 1,400 taxable, if I have a lot of RRSP money, I might lose some OAS. I might lose some GIS. So, but if I take 600, I might get my GIS. So it depends on what other stuff you're doing. And I'll show you GIS right away, the calculation, and then we can decide together, hey, what makes the most sense? But if you take it early, you might get less. You might get more if you wait. You might get even more if you wait longer. But let's say you wait till 70, but you die at age 69. Well, you don't get it. You missed out. You missed out 9 years of $600 a month or whatever your numbers might be. So when you look at this stuff here, before age 65, you get a reduced. After age 65, it increases. So the longer you wait, the better it is for you. But the sooner you take it, of course, the better it is for you. So you get it's taking money is also good too, depending if you save it. Sometimes people just spend it. Maybe if you go to the casino for 9 years, maybe it's not good. But maybe if you save that 600, it could benefit you as well. So this is a unique one. So here are the rules with OAS. Sorry, with GIS. You got to be under 19,000. So where people get income from is typically you're going to get OAS, CPP, pension, that says RRSP, and maybe a job. So when we add these up, it says here, it provides a monthly non-taxable benefit to lower income OAS recipients, which means OAS is not counted in the equation. So let's say someone doesn't have RSPs, they don't have pension, they only have CPP. And if their CPP is $8,000 a year, they're under the threshold, so they're going to get their GIS. Maybe they put all their money into insurance and TFSA. And a house. They paid off their house. So if you pay off your house, pay off a policy, fill up your TFSA, those don't count as income. So now you might get your GIS. But if you save in a pension and a job, part-time job, you might not get your GIS. So tax-free income is typically non-income income or non-income cash flow. So it gets you your GIS. The main question is, is it going to be enough? The way we figure out it's going to be enough, typically we just go like this with a client. We say, well, let's figure out what your expenses are. And everyone has fixed expenses. So fixed expenses is your rent, your taxes, your property taxes, stuff like that, stuff you have to pay. So if you look at your bank account, stuff that hasn't changed in 2 years, that's a fixed expense. Then you have variable. This is my fuel to get to work. It's my grocery bill. It's a bill I have to pay, my grocery bill, but it's a variable bill. I could eat soup every day, or I could eat, tofurkey every day. Tofurkey is more expensive than soup. So here, I also have discretionary. I don't know how to spell discretionary, so I got lost. That says discretionary. Discretionary, I crossed it off because it's so bad. Discretionary is going for dinner, doing fun things, doing different things. And then you have fun expenses. And so you want to stack up your income in the same way. You want to say, what is guaranteed? CPP, OAS, pension. Then you want to know what's expected. Expected income, I want to match to my variable expenses. Then I want to have options. For example, a lira has to be drawn at a certain speed, so it's expected money. Options is like a TFSA. I want to use that for my discretionary. And then here I have extra money. Paid off my house, paid off my policy, paid off my car, stuff I don't want to sell, but if maybe I'll sell one of my cars and go have fun. So we want to match our income to our retirement and figure out, hey, how is it going to work? How am I going to pay my bills? Because bills come in no matter what your age. So this shows here government benefits aren't supposed to cover your total retirement. You still have to have other personal savings. And so when you look at, that's the government. Any questions about government? Now is a good time to ask because we're going to move on. If you have a question, type it in. Company pensions. There's two main types of company pensions. One is a traditional pension plan, also known as an annuity. So an annuity is the technical term. Usually the employer pays for it. You get a defined plan. We call it a defined benefit pension plan. It's very expensive and you don't have any control over it. The defined contribution is paid for by the employee. Some employers match it. So sometimes you match 2% and you put in 5, or they can give you a little boost. The amount you get is defined by your investment performance. And then your investment responsibility, your fees are all based on what the employee chooses, and they get to choose how it's invested. And you have control. Now, I don't know which one's better, because sometimes you look at having control is better, but if you have the skill. Some people have control, but they're afraid to invest. So then it's better off a pension would do it. And other people don't have discipline. So if they were given a lump sum, what would happen is they would lose it all, because they'd spend it all because they don't have discipline. So they need the monthly income that lasts a whole lifetime. But a defined benefit is much more expensive. It's also rarer. And when people talk about a pension they're going to get, a defined pension is typically thought of as more valuable. But not all pensions are equated equal. I just dealing with a client now. They've been in business 47 years at the same company, and they got not even 200 grand in their pension. So we can draw, safely maybe $1,000 a month for the next couple 10 or 15, 20 years, but not a lot after 50 years. So every industry has different pensions. Over the last couple of decades, we've shifted to personal savings, and employees bear the responsibility and the risk. And so they say, hey, if you're not going to if you want to have the lifestyle you have now, you typically got to put some savings together. And then where you put that savings matters. We're going to cover some of these options. A mutual fund is basically an investment that came out after the Great Depression 100 years ago, because individuals were investing in things with no structure. So the industry was born. They said, well, let's give people some structure. So investors can purchase shares of a fund instead of shares in an individual company. And then the fund buys individual companies. And then the content and the risk of the portfolio is based on the fund's objective. Here's some advantages. Low investment minimums. You could start off with a couple $100, and then start monthly. By law, you have to be able to get in and out of the investment every business day. So in a mutual fund, they can't put in investments that are not liquid. So you can't put in things like private equity. You can't put in things like real estate that's not be able to price on a daily basis or be sold on an exchange. And you have diversification where you are spreading your risk out. You're not just buying one stock. And you get professional money managers. They research and they select and they monitor the performance of the fund. I think, as much as a bad name mutual funds might get, if you look at social media, a lot of people want to sell things other than mutual funds. But at the end of the day, they help more people retire than I think any other product out there other than pension plans. Really, it's a safe way for an average person who doesn't know a lot to be able to invest and get better returns than maybe the banks offer. Now, every mutual fund has fees, expenses, risks, and there's something called a prospectus or a fund facts that has to be reviewed by the client before making a purchase. But I think a mutual fund is a great option for people to put their money. A segregated fund combines the growth potential of an investment fund with insurance protection. Most people own segregated funds. They just don't know it's called segregated funds. Basically, a segregated fund, if I look at a mutual fund takes the money and puts it in the market. A segregated fund takes the money and puts it in an insurance company's reserve. And then the insurance company, this is the insurance company, they take other money and they put it in the market. So your money is not actually in the market. It's segregated from the market. You give your money to an insurance company, and the insurance company puts their own money in the market, and then they have a different regulator. That's the main difference. So they're regulated by the insurance industry because it's reserve money. But you're guaranteed to get either 100% of your money back or 75% of it. You can have different guarantees where you have guaranteed never to lose. You can have a guarantee of 4% growth. Or the market. So you can say if the market does 20, you get 20. But if the market does 9 minus 20, you get 4. So you can do a lot of stuff like that. But the main thing is, it's just an insurance company's mutual fund. If you've heard of Canada Life and you have a pension plan there, or Manulife, or Equitable, or Industrial Alliance, or Great West Life, or any of these life companies that do group plans, it's typically segregated funds. It looks exactly like a mutual fund, just a different regulator. Some of the advantages: a principal guarantee, a death benefit. You get creditor protection if you choose the right beneficiary. Only if it's a preferred beneficiary, you get creditor protection, which is like a spouse or a child. I can't put my business partner or my brother as a beneficiary and expect creditor protection. Sometimes there's additional fees depending on how many guarantees you get. They're not always additional fees, and they're liquid. But if you want the guarantee, you got to wait till the term matures. So an annuity is like an individual pension plan. Looks like this. With an insurance product, it helps address a risk of outliving your money. While life insurance helps protect against premature death, an annuity can protect against living too long. You give a large lump sum of money in exchange for a series of payments. These have not been popular for 20 years, but now that interest rates are up, they will be popular again because now interest rates are 5% instead of 1. So nobody wants a 1% guarantee, but 5 plus, it starts to look a little better. So when you buy an annuity, they're based on the long-term interest rates at the time you buy it. So if you bought an annuity 3 years ago, it wouldn't be as good as an annuity today. And then we have different ways things get taxed. So in summary, when I look at, if I do I'm going to come back. You can buy an investment account, which is basically a mutual fund with a limited guarantee of a segregated fund. So it's a segregated fund that's built as minimum guarantees as possible to look like a mutual fund. And then there's no extra fee. So you still get a death benefit on your principal, no extra fee. Beneva puts a lot of this stuff in place where it's we call them a 75-75. But it's just a stripped down segregated fund to look like a mutual fund. Now we're getting into different structures. So an RDSP, who can buy it? Only if you're eligible for the disability tax credit. So if you have a disability and you get a disability tax credit, you can buy this. You could put your money in RDSP. I'm going to summarize this right away, but you can have up to $1,000 a year and you can go back 10 years. And so you can get 10 grand right away. And then on the bottom here, you can get up to 300% of what you put in. So let me, I wonder if we can get a blank page. No blank pages. I will make a blank page. Can I do this? No. I will do it like this. I figured it out. So there's 4 types of money. I'll just draw right on top. You guys can see it on top in red. You have a grant that's 3 times what you put in. That's what that says. A grant that's 3 times what you put in. Then you have a deposit. So if you put in $250 a month, the grant is $750 a month. So right away, if I have someone who has diabetes, they have a learning disability, they have some kind of disability that's out there, blindness, deafness, can't drive at night. I got a lot of them that like this. They can put in $250 a month, but in reality, they're putting $1,000 a month away. Then you get $1,000 a year for 20 years, and you get interest on all your money. So that's how I explain it. I say you get grants, deposits, a bond, which is $1,000, is called a bond, and you get interest on your money. And I just draw it out like this, and then I say, how much do you want to deposit? You can do $50. At about $300, anything above $300, you start losing grants because the max grant you can get per year is $10,500. So there are some limitations getting into the weeds and some details, but the RDSP, think about as free money, 3 times your money with some limitations getting into some details. The best way to go to find this out is rdsp.com. rdsp.com. RRSP. What you need to know about this, 2 things. When you put money into an RRSP, it's going to be tax deducted from your income. So if I make $100,000 and I deposit into an RRSP $10,000, I'll be taxed on $90,000 because I'm deducting it from my taxable income. The second thing you need to know is when you pull that money out, it's going to get taxed. So I get a tax deduction now and I just pay later. So it's just a tax deferral program. It's nothing super technical about it. And there's some limits to how much you can put in. When you're choosing an RRSP, you get to choose how it's invested. So you can look at different investment options. You do not pay tax. It's a continuous tax deferral from go to one RRSP to another. To transfer an RRSP, there is no taxes. And you want to ensure you match your risk profile. If you're saving for an RRSP and you're saving to buy a home, we have a new program called an FHSA. An FHSA, you can move an RRSP to an FHSA with no tax. And if you use a first home savings account to buy a home, there's no tax. Up to $8,000 a year. So you can get money out of an RRSP in a better way. You can still do that program I just crossed off, but an FHSA is better. And I think it should be done first. You get $8,000 this year, $8,000 next year, up to $40,000 in room in FHSA. If you're married, it's $80,000. That's a lot of down payment. But you want to look at the options you have so you could control your own money. Tax-free savings account. This is the simplest of all of them. When you put money in, no matter how much, there's no tax. If you take money out, you can recontribute the following year, and you get about $6,500 a year last year or this year, and so you got about 85,000 of room if you've never used it and you've been 18 for a while. One of the things about a TFSA that I like is that if I put money in a TFSA, I never pay tax on it. So if I'm saving for my son's school, I have to decide, hey, I never pay tax on this. So let's say I save $10,000 in an RESP. So I got $10,000 in RESP or $10,000 in a TFSA. Well, the RESP is going to get a gross up to $12,000, right? From earlier, you get 20% in the RESP. But the RESP, the growth is taxed in my son's name. So if it's invested a long time in most of its growth, my son might pay more than 20% tax. So if his tax bracket is more than 20%, a TFSA might be better for his education than a RESP. And it's thought that the RESP, you get to use a tax deduction from tuition to offset the tax. That's why it's in the kid's name. But in a TFSA, I could use a tax deduction from tuition to offset his income. So it's a great option to say, I'm not sure which one to do. So I can fill my TFSA until my son's 8, 9, 10, 11, 12. And then start moving into RESP when I'm sure he might go to school. Or when I'm close to the maximum amounts. I can also do this for retirement. When you pull money out of a TFSA, tax-free savings account, it does not count towards income towards your GIS. So if you're making $30,000 a year in retirement income, all from TFSA, it doesn't claw back your GIS or your OAS. So you might be able to max out your other benefits, and it doesn't increase your tax bracket. And if you're pulling money out and you have young kids, if you pull money out of an RRSP, you might lose your child tax credit. But if you pull money out of a TFSA and you have young kids, you don't lose your child tax credit. So all these pieces kind of fit together that the lower income, more benefits. Well, lower income is lower money to spend. It's a different balance, right? So that's TFSA. Now you can say, I don't want to register my money with the government. I want to check if a box says open or non-registered. Now, not all investment income is taxed in the same way at the same rates. There's 4 types of tax. It's not in the workshop, but we're gonna touch it a little bit because we're on page 48. We have dividends. We have capital gains, which is a 50% inclusion rate. We have income and return of capital, or we call ROC. A dividend, the corporation in Canada, a Canadian dividend, the corporation pays Canadian tax. So if they pay a Canadian dividend to you, you get a reduction in the tax paid. If you have low income, dividend income can be tax-free because the corporation paid some already. A capital gain, you only pay tax on 50% of the gain. So it could be a benefit to you. Income is the worst kind. It has a 100% inclusion rate, and you get taxed at your marginal tax rate. And income counts against your GIS, OAS, and increases your taxes. Return of capital, no tax, doesn't count against your government benefits. So if you are doing non-registered investments, you want to look at how it's taxed. A life insurance policy is considered non-registered. It's considered open. It's not an RSP, it's not a TFSA, and there are 4 ways to get money out of an insurance policy. One is a policy loan. If there's growth in the policy loan is taxable as the same percentage. So if I put in 10,000, it grows to 20. So my ACB is 10 and 20,000 is my growth. 50% of what I pull out is taxable as income. It's not a policy gain. It's a policy gain is not a capital gain. It's income. I can also do a withdrawal. Exact same rules as a policy loan. If there's growth, it's taxable. I can do a capital or collateral loan, which is a bank loan. A lot of times there's limits on what we can do. We do them many times through Equitable Bank in Canada or Manubank. And Equitable Bank has a great calculator, nothing to do with Equitable Life Insurance, to go look at that. Or I can cancel. Out of all 4 of those, if there's no growth in the policy yet, which is under the ACB, it's tax-free. But if there's growth, the policy loan, withdrawal, and cancellation are taxable on the growth. The collateral loan has no tax. But it might involve a credit check. So it might involve, hey, they're going to give you a loan. You have to have decent credit. You can't do that after you run out of money, because then your credit probably sucks. So different ways to get money out. Every time you have something that's cool and good for you, there's complications too. But where's your money going to go? Hey, look, we look at different options. When you make money, you're going to pay tax. When you spend money, it's complicated, but you pay tax too. The retailer pays it for you. When you save money and you want to become a saver, they're going to tax you. That's why savers study taxes. And of course, if you pass away, they might tax you too. And we want to look at some of this stuff and figure out, hey, if I'm paying money or if I'm saving money over time and I got a good rate of return, I got to beat inflation, but I want to look at the tax to figure out how can I minimize my tax. To summarize this, FHSA is also tax advantaged, but I get a refund when I put it in. It's brand new from the government. I suggest looking it up from the government's website. Tax now is also your employment income. You get taxed as it grows. It's just 3 different buckets. Tax later, you get taxed when you pull out the money. Tax advantaged usually means tax-free. There's 4 perfect places to put money that are tax-free. Your tax-free savings, life insurance and critical illness benefit, your primary residence, and FHSA. Disability insurance is the only way to get money out of most disability insurance policies is to get hurt, be disabled, to make a claim. But you could get money out of a critical illness, a life insurance, TFSA, without being disabled. That's why I didn't circle disabled, because I don't plan on claiming my disability insurance. That's not part of my financial plan. But you hope, right? So let's summarize it again. Just as let's look at the different rules, and let's look at them. There will eventually be FHSA. That's what that says in chicken scratching. So RRSP, what you need to know is when you withdraw, it's taxed as income. But you get a tax deduction when you put it in, which is a good thing. Non-registered, it is subject to tax, but you could borrow against it, and a corporation can own it. So when a corporation is saving money, a corporation can't buy an RSP and cannot buy a TFSA and cannot buy an FHSA. They can only buy insurance, either a fixed policy like whole life or a variable policy like UL, or they can buy non-registered. So if you want to deal in the corporate market, we want to get good at that stuff. A TFSA, the main thing to know is no tax on the growth, no tax on withdrawal, and a corporation cannot own it. Permanent policy, there are tax advantages. A corporation can't own it. In fact, many of them do. And one of the things is when you sell an open investment or when you sell an insurance policy, which means cancel it, it becomes taxable if there's growth inside the cash value. So we don't typically sell non-registered investments and we don't typically sell insurance. A rental house is considered non-registered. So you don't sell it. What you do is you refinance it, take out the cash, which is not a sale. That way you can access some of the money without paying tax on it. And FHSA, the same benefit here. Oh, I think I made the same benefit here. Yes. It's tax deferred. Yes. Requires minimum distribution after 15 years. You can only hold it for 15 years. When you withdraw, it is tax free. Who can own it? An individual only. And you have to cash it out to get it. So it makes it more confusing when I look at the screen and I don't even know what I wrote. But if you are recording it, that is FHSA. It's a new program. If you're, by the way, if you're saving for a house, the basic rule is this: if you have RSPs, move them to your FHSA, or if you have a good income, put your money in FHSA and take a tax deduction with it before buying your house. Let me summarize one more. I got a few more minutes, and here's the question before I summarize. If I had $1 million, where would I want to put that money? Would I want to put it in RSP, TFSA, insurance, non-registered money? You know, and usually you want to, it's not what you own, it's what you know about what you own. I know a lot of people that have a lot of RSPs and they don't know a lot about how they could get better rates of return or how they could be invested properly. So we want to know about what we own. Let me do a quick summary. And let's show RRSP versus TFSA. Just purely tax later RRSP versus TFSA. If you're writing it down, if you're at a textbook, you might want to write it down on in the graph on the top of page 49 where it says where is your money going. You can kind of draw it in that chart, or just a piece of paper. Let's say I'm going to do $5,000 per year. I get an 8% consistent return for 30 years. 5,000 a year by 8% over 30 years, it's going to equal $600,000. Now, should I put that in TFSA or RRSP? That's the main question. Well, here's some of the assumptions we don't know. We don't know the rate of return you're going to get. We don't know what your emotional, could you hang on to an investment? We don't know what rates are going to be in the fixed income market. We don't know if you're going to have a disability. There's many things we don't know, but we also don't know the tax rate. So I have to assume the tax rate when we do this. If I can touch, I don't know if I can change my color. I cannot. So in RRSP, you might get a refund of $2,000 for every $5,000 you put in. A TFSA, you're going to get taxed $2,000 because if I earn 5, I got taxed on 7 to keep 5, and $2,000 is, it goes into 5. Let's call it 40%. But it's a little different because you earn 7 and keep 5 and put in 2. But let's say I put RSP, I get a refund. TFSA, I don't get a refund. In fact, I'm taxed $2,000 times 30 years, which is $60K gone to the government from employment income. Now let's look at retirement. Let's assume we make lots of assumptions with financial planning. So forgive me if my assumptions are different than yours. You just rerun the numbers. So here we go. Someone asked, FHSA's first home savings account. Here we're going to draw out 6% of our asset, and we're going to make a crazy assumption that our $600,000 is going to do 6% every year. You don't have a, we don't do that right now, but we're going to say, hey, at 6%, that's going to draw $36,000 a year. So now, if that's RRSP and you're taxed at 33%, the tax is $12,000, and you get to keep $24,000. A third of your money goes to tax. I don't know if it will be a third at the time, but I'm assuming a third right now. So you get to keep $24,000. In the TFSA, for 30 years, you never got a tax refund. So now you think it better pay off. So now you get to keep, no, why not? You get to keep $36,000, same 6%, same investment, instead of keeping 24, because no tax on TFSA. Now we're going to make another assumption. You have no other income. You have no CPP, and your OAS does not count to GIS. So if you have no other income, you might get your GIS, guaranteed income supplement, maybe $1,000 a month. I don't know. There's a GIS calculator. If you have no income, you get GIS too. Over here, this guy's rich, no GIS. He's too much income. So now this guy somehow in this equation is living on 48,000, and this guy's living on 24,000. And the one is paying tax and one is zero tax in retirement. Now, if you get CPP, that counts as tax. This situation is rare. If you die, what happens is this 600,000 counts as income over here, but not income in TFSA. So if you earn 600,000 in 1 year, 300K goes to tax. So now I got no tax. So I look at, hey, what if I'm doing retirement planning? TFSA might work well. But if I'm doing debt planning, trying to get you out of debt, you might need that refund to apply towards your debt. But I want to be able to do the math with my clients to say, hey, where are we putting the money, and which ways are tax free? What's really tax free? Not tax. Sometimes we say tax advantage because sometimes it's tax free, sometimes it isn't. Just like my home, if I just pay it off, it's tax free. But if I rent it out, it's no longer tax free. Or if I depreciate it, it's no longer tax free. In summary, hey, when we're looking at big goals, things like higher education, the main thing isn't where you save, it's that you save. If someone saves money in a bank account or a TFSA or an RESP or pays off their debt and someone else doesn't save, it doesn't matter what the non-saver knows. They didn't save. And so it's an issue of structuring something where you're actually moving forward. When you look at retirement, not being as scared of the government, saying, hey, are they going to take care of me? How much are they going to give me? But I can think, how can I maximize what they're going to give me by structuring my life in such a way where I don't have I get the most of what they're going to give me. And even one of the questions, I've talked to a lot of business owners who they say, hey, I'm going to do a dividend payment instead of income when they have a corporation. But if you only take dividends, you don't pay CPP. And when you retire, you don't have any CPP. And so we want to look at the whole picture so people can plan their retirement properly. And you always want to be understanding and reevaluating your finances with someone you trust so they can give you good ideas. But hey, one of the greatest miracles, you change the way you understand things, you change the way you think, you can change the way you act. And we want you to connect with the person that invited you, reach out and let them know, hey, I was at a workshop, it was pretty good, and I want to learn how to apply this, or I want to review my own retirement or review my strategy, and take care of whatever I want to take care of, get my questions answered. I have a website actually Google website, Google Maps on my office. I'm hoping if we did a good job today and you learned something, you could give me a review and add what you learned. A 5-star review and then something you learned. It helps when people search me. They say, is Daniel a real guy or is he just an online character? I can say he's a real guy. He has reviews, and I appreciate your extra time sending that in. We are out of time, but if you have a question that's a general question, I definitely have time to answer it and make sure you get taken care of. Any questions before we take off?
Thank you, Daniel, for your time and your explanation. It was so useful, but it somehow was difficult for me to actually get all of them in one course. Is a kind of economic course for me.
It is. It is impossible to learn everything in 1 hour. We actually offer this exact same course in 5 hours from now at 7 o'clock, and then at 9 o'clock again Central Time, from 2 different instructors. The instructor at 7 o'clock Central is a good friend of mine, does very well with us, got a big team. He articulates very cleanly. And the more you see it, the same material with different instructors, that's the way to learn. It's not I wish like 1 hour, boom, you're expert. Yes, but seeing it 5 or 10 times, you think, now I start to get it. So that repeating is the way to do it.
Thank you, Daniel.
So I appreciate the reviews, everybody.
Thanks so much, Daniel.
Thank you.
Appreciate your time and your effort. Thank you.
Anyone here going to Hawaii with us?
Yeah.
Me too. Good to see you. I look forward to meeting you in Hawaii. So awesome, guys. Let's take off for the day. Have a good day.
Have a good day. Goodbye.